All right. Well, hello and welcome, everybody. We are excited to be here with you today talking about a really interesting topic, which is relocating in retirement. And whether you're thinking about moving or buying a second home, there's a lot to be thinking about. So we're going to break it all down for you into a organized planning process. And by the end of today's session, you'll have the information you need to make the transition as smooth as possible, while also avoiding some of the common mistakes we see. So whether your move is motivated by lifestyle, climate, family, taxes, or some combination of those things, I think you're really going to enjoy today's session. And we're going to kick it off with a poll question. And the question there is, where do you want to go? So you should see a poll popping up here in just a second. We've listed some of the most common destinations that we see. So Arizona, California, the Carolinas, Florida, Nevada, Texas, or other. Really interested to hear the other, actually. So if you'd like, you can go ahead and type in your other answers into the Q&A box. I see we got quite a few answers already, almost up to 100 already, so that's great. While we're waiting for everybody to submit their answers, I'm going to give you a quick introduction. My name is Justin Smith, and I'm a financial advisor in our Phoenix, Arizona office. And I'm joined today by Jeff Lewis, an advisor out of our Rockford, Illinois office. All right, I think we've got most of our poll results in, so I'm going to share this with everybody. And it's surprising, actually, the most popular is other. Some of the perennial favorites like Florida and Arizona have made the list here, which is not a surprise. California, which at some points was a retirement destination, we have very few people thinking there. The Carolinas also looking popular. And despite some of the tax benefits, Texas and Nevada only have a couple of respondents. So interesting results there. Again, we're trying to give everybody the tools they need to make an informed decision about where they want to go next. And again, as we move through the presentation, we'd love to hear about what other might mean for you. So whether that's a different state we didn't list here, or maybe something that's more exotic, we'd love to hear about it. So we're going to move on now, and I'm going to stop sharing those poll results. And let's go talk about relocating in retirement. There's a lot of complex decisions here. This is a really exciting time, but there are also a lot of moving parts, and they're all connected. In fact, when we look at the 10 key areas of your financial life here, 7 of those 10 areas are impacted when you're looking to relocate in retirement. So it's a good thing we're here today. And let me talk about our agenda. We are going to review the mechanics of selling, purchasing, and financing your new home. We're going to talk about how this new property will fit into your balance sheet and your estate plan. And of course, we're going to talk about taxes, how that might change and how you can optimize around that. We'll then wrap up by tying it all together into a 7-point action plan. And we're going to be sure to leave a few minutes at the end for your questions. So with that, I'm going to hand it over to Jeff Lewis to start talking about the mechanics.
Yeah, thanks, Justin. Certainly appreciate the introduction. One of the things that, you kind of start the process of going through potentially thinking about a second home or relocating now that you've kind of entered that next phase of life. And the first thing you really start thinking about is the mechanics, asking yourself some of the most common questions as it relates to, what kind of house are you looking for? What are you going to purchase? So some of the questions that you may be asking yourself at that point in time, what's feasible for me? What can I afford? How does this fit into my overall budget? That's probably the first question. And then some of the follow-up questions related to that are, okay, well, what's the impact on my total nest egg? And then on a monthly basis going forward, how does that impact my cash flow? So when you're kind of beginning that purchasing, when you're going through that purchasing process and you're kind of trying to identify a price point that works for you and fits within your overall plan, those are going to be some of the things that you're thinking about and some of the questions that you'll be contemplating as you get through that. It's really important to identify a number within your budget that's going to work for you, not only on a monthly basis, but in terms of coming up with money for a down payment if you're purchasing a second property. There's a lot of moving parts to that. So making sure that you're asking yourself the right questions at the beginning can help get you through some of the next steps. Once you've kind of identified, what you're going to purchase, or at least that price point, the next question you might ask yourself is, well, how am I going to go about paying for it? Are you going to finance it? And if you do finance it, what are the things to be thinking about? Because typically with a second home or a second property, most people think as a standard down payment as 20%. However, if this is a second or a third property, a bank or a credit union may actually require you to put down a higher percentage, 25, sometimes closer to 30%, just to reduce the risk, knowing that it's a second home. So there's different considerations as it relates to your mortgage. Obviously, right now, we're in a really low interest rate environment where taking out a mortgage can be an attractive option for a lot of people because the interest rate on those mortgages are extremely reasonable and extremely affordable. So that's kind of your more traditional sense of mortgaging a potential property. But there are some other additional options that you could be thinking about as well. One of them, or two of the most common in the past, being a home equity loan or a home equity line of credit against your primary residence or your existing home. However, those have kind of fallen out of favor here over the last couple of years, just because going back to 2017, when they changed some of the tax law, you can no longer deduct interest on your tax return for a second home if you're using those funds to go towards a second home. So it's not as common as a strategy that once was more popular before they changed the tax law in 2017. However, another option may be what is called a margin loan. Basically, you're lending money to yourself via your investment portfolio. So if you have a non-IRA brokerage account, you're actually able to margin up to 50% of that account and loan yourself money. However, not saying 50% is what is advisable or recommended, but that's just the maximum amount you can do. And then over time, you end up just paying yourself back, through an amortization schedule on a monthly or an annual basis to pay that loan off over time. So that's an additional option that may be an option for you if you don't want to go the traditional financing route of a mortgage. The other option potentially could be a 401k loan. However, the only problem with the 401k loan is they tend to be a little bit more stringent on how much you're able to borrow. And depending on how much you may need for a down payment on a second home, it may not be a viable option. So those are just a couple things to think about as you go through the financing portion. Obviously, one day, you buy the second home, you enjoy it for 10, 15, 20, 25 years. And then maybe at that point in time, I'm going to sell this at some point. This is not something that I want my kids or grandkids to have to hold on to or to have to manage once I am no longer there. So in my head, I want to think about selling the property at some point down the road. So some of the things to be thinking about are timing. What's your timeline for this? Is it 10? Is it 20 years? How does that fit into your overall picture as it relates to your finances? The second one being liquidity. Obviously, real estate is not as liquid as a natural stock bond portfolio. It takes a while to turn your real estate into actual liquid cash. So you got to be thinking about a timeline. Okay, if it's going to take me 3 months to get this property from put it onto market to sell it to get the proceeds of that into my bank, that's something you want to be thinking about as well. And then lastly, as it relates to selling, thinking about the potential gain exclusion, remember that the IRS does allow for up to a certain amount to be excluded from taxation if it is a primary residence. However, if it's a secondary residence or a second home, those properties do not qualify for a capital gain exclusion. So when you sell that property and you sell the property for more than what you paid for it, there is going to be capital gains tax implications at that point in time. So you'll want to be making sure that you're taking that into account as well if this is truly a second home. Justin, I'm going to throw it back to you so you can wrap up some of the action items related to the mechanics and then kind of going into the next topic, related to the balance sheet.
Perfect. Yeah, so let's review our action items from the mechanics. The first is that you want to analyze all the different options for purchasing and financing your new home. There are a lot of different ways you can make this happen. You want to find the way that works best for you in your financial situation. And the next part is that you need to coordinate your timeline. You've got to get all your ducks in a row, make sure these transactions sync up. And it's also a good time to start thinking about tax timing as well. And we're going to dive deeper into taxes in a little bit. But our next section is going to be talking about your balance sheet. Specifically, how will you hold this new asset and how will it interact with the rest of your financial picture? So the first thing we want to think about is how will you be using this property, and therefore, how should you hold it? Because second homes can be used in a variety of different ways. It could be full-time personal use, it could be part-time personal use, part-time rental, full-time rental, or some combination of the above. Each usage pattern will bring up a variety of planning considerations, specifically around the insurance you hold on the property, the taxes, the financing options. This is also going to play into how you should title the home. So you can hold your new property individually, you can hold it jointly, you can hold it in a trust, you can hold it in an LLC. There are even 9 states that have a unique form of joint ownership called community property. So this comes with some beneficial tax treatment stemming from a double cost basis step up, but it can also complicate things in blended families or second marriages. So if you're buying a house in one of those highlighted community property states, be aware of the rules and be planning ahead for that. You'll also want to be sure that you coordinate your new home into your estate plan. And often this can mean titling the home into the name of your trust. And we'll touch on this later. You'll also be wanting to think about potential estate tax ramifications if the property you're looking to purchase is in a state like Illinois, for instance, that has an estate tax. And finally, there could be some interesting opportunities to think about for multi-generational wealth transfer here. If you have a property you'd like to pass on to future generations, often this can be like a family lake house or something like that, there are some advanced strategies that you should probably consider. The most notable here is something called the Qualified Personal Residence Trust. We abbreviate that as QPERT in the financial planning world. But this is simply a way to pass down a home to the next generation with a substantially reduced estate tax burden while still getting to enjoy the property in the meantime. So if you are subject to estate taxes or might be in the future and have a property that you'd like to pass down for multiple generations, this is something to be thinking about. The next thing to be thinking about as it relates to your balance sheet is rental considerations. There's a lot of different things here to review. And the first one is cash flow. People obviously like the idea of renting, whether part-time or full-time, because those rents can defray the cost of ownership and make it a little bit easier to handle that second property. But where people get into trouble is that they don't actually do all the math up front. And often the net cash flow doesn't quite live up to expectations. And in that situation, you can end up financially strained. So if you are going to rent, you need to model out what does the net cash flow look like over time and make sure that that's going to work with your financial picture. A related point here is to understand your true return on investment. Many people will purchase a second home and call it an investment, but that can again be problematic if you're not analyzing it and treating it like an investment up front. So you do need to model out, understand what factors might cause you to make money on that investment, what factors could cause you to lose money on that investment, really get a firm grasp of the true risk and reward of this investment, because that's how we make smart decisions. And of course, if you're renting, it's going to impact your taxes as well. So if you do have positive net income after all your deductions, after depreciation, you are going to owe ordinary income taxes on that net rental income. And then more often than not, we actually see people with losses on their rental properties. So in some cases, you might be able to deduct those losses, but you do need to check a number of boxes. You need to fit certain criteria. So I wouldn't just count on having these tax losses from a rental property that you can use to offset other income. And then another quick anecdote on rentals is there's something called the Augusta rule that I think is fun to talk talk about. So technically, this is called the Section 280A exemption, but it got its nickname from people living near the Augusta National Golf Course, which is where the Masters golf tournament is held. So the rule states that if you rent your home for less than 15 days a year, you don't need to report that income, and it's not taxable. So this obviously became a popular strategy for people living around Augusta to collect some really big rents for 2 weeks during that Masters tournament. So that is what we have, and Jeff's going to give us the review of the balance sheet considerations.
Yeah, I like that Augusta rule. If we've got any big, Augusta golfers that live near around the golf course, I'm your guy to hook up for a potential rental. But no, that's a great point, Justin. Thanks for bringing that up. But in terms of just summarizing some of the action items that Justin just spoke about, obviously, first and foremost, determining the appropriate titling and coordinating that with your overall estate plan. That's extremely important as it relates to beneficiaries and heirs after your passing. Having things titled correctly and appropriately can help them from a coordination standpoint and just administering the estate planning process. So just making sure if you do go through this process and you do end up purchasing a second home, just making sure that it is actually incorporated into your estate plan and it's documented well in there. And then second, just conducting a thorough, examination of the rental considerations. Like Justin said, if you're truly buying this as a rental for an investment property, well, then you should treat it like one, and you should track, what your return is on that investment. Some people may be more just, purchasing it as a second home for their enjoyment, and that's certainly okay too. But it's just important to understand why you're purchasing it and then treating it, for the best use case for what you deem it to be appropriate. Just moving on here, kind of to the next section of our presentation is obviously taxes. Taxes play a daily role in all of our lives, whether we like it or not. So it's important for you to consider, potential not only income tax consequences of purchasing a second home and potentially changing your residency, but also what are the estate tax consequences as well. So first, talking a little bit about domicile. So what is domicile? Well, really, it's just a fancy way of saying this is where you claim your primary residence. So if you are familiar with the 6-month rule and how your residence gets determined, typically speaking, if you spend more than 6 months and 1 day in a particular state, you're going to claim that as your primary residency for that particular state. However, there are a couple other examples and things that should be considered as you're going through that process of establishing domicile. You'll definitely want to make sure you update kind of your voter registration cards and making sure you're voting in the state that you're actually claiming domicile in. You want to make sure that your driver's license is up to date, mailing addresses, making sure that you're actually using that property as what it's stated for. And then, most importantly, kind of tied into what Justin was talking about as it relates to the estate planning side, if you're relocating or changing states in retirement, you'll want to make sure that your estate planning documents are drafted for the state that you are now living in. That's really important as it relates to how your estate is treated upon your death, and it can just create an unnecessary headache for those who have to deal with it afterwards if those are not updated, during your lifetime. So just be keeping that into consideration as well. As far as state taxes go, obviously the one we're most familiar with as consumers are income taxes. However, once you're retired, you're going to have potentially different streams of income. You could have rental income, you could have Social Security income, you could have dividends and interest from a brokerage account, distributions from an IRA or a 401k. And depending on what state that you're actually residing in, all of those different income sources could be treated differently for income tax perspectives. So the main one that retirees tend to think about is Social Security. If you're moving to a state that potentially taxes or does not tax Social Security, what does that mean for you? Now, I will say most states or a lot of states do not actually assess a state tax on your Social Security benefits. However, there are a number of states that do kind of adopt the federal rules, Montana and New Mexico just being two of them that kind of just more so adopt what the federal government does from a taxation standpoint. And then obviously there's the states that don't have any income tax at all. Florida being probably the most well-known for retirees looking to relocate. Also, it'd be good to consider kind of, where do you fall in terms of individual income tax brackets? States are a little bit different from the federal government. When you think about federal government income taxes, everybody's pretty familiar with it's a graduated marginal income tax rate. So you start paying at 10%, you graduate to 12, 22, 24, so on and so forth. Whereas the state income tax can be a little bit different. Some states assess a flat tax. So the state of Illinois is a flat 4.95%, no matter what level of income you have. Whereas other states, like Arizona, have a more graduated income tax rate, similar to the federal government, just with their own different percentages as it relates to their debt tax code. And then obviously states like Florida and Texas not assessing income tax at all. So just be familiar with, where you may fall in terms of a state income tax bracket, if you're potentially thinking about relocating and changing your residency and comparing that to where you live today. Outside of just state income tax, then other state tax to be thinking about is the estate tax, or more famously referred to as the death tax. If you by chance happen to hear politicians talking on TV and debating. The nice thing about the death tax is there's actually only a handful of states that actually assess a death tax, or a tax upon once you pass away. However, most states also allow exemptions. So not to, punish the middle class families that have been good savers over their life, or the family business or the family farm. There tends to be exceptions and exemptions built into the tax code. But it's still important for you to understand, if you're moving from Missouri that may not have, a death tax, but then you're moving to maybe Oregon or Washington or wherever it may be, depending on whether you have a large enough estate or not, to just take that into consideration as you kind of go through that plan. It's, certainly not, an indicator of whether you should, definitely move somewhere or not. I always tell people that taxes is a secondary decision to their ultimate goal of being where they want to be. But at the same time, it's definitely something you should at least be aware of and be mindful of before you make that decision. So Justin, I'll go ahead and send it back to you, and you can kind of wrap this up and move along.
Yeah, so let's review our action items on taxes. First, you need to determine which state is going to be best for your unique personal financial situation. It's not always clear. So you do need to run the numbers and understand the true impact, because there are things like the rate structure, exemptions for certain types of income, the estate tax. It's more complicated than just looking at that top line rate. Next, if it is going to be advantageous for you to become a resident of a different state, you need to make sure that you sever domicile in the current state and take active steps to establish domicile in that desired state. So let's move on now and tie it all together into our 7-point action plan. And the first thing here, which we haven't even talked about yet, but I think this is really important, is take a test drive. Spend some real time at this new location. Understand the ins and outs of it beyond just the typical tourist destinations. Really explore outside of Main Street, and get a feel for what your typical day, week, or month might look like in this new place. So fortunately, it's never been easier to try it before you buy it. Things like Airbnb make it really easy to get a rental for a few weeks or even a few months. And that allows you to make sure that that new location really suits you. Number two, make sure, again, that you're analyzing your purchase and financing options and personalize your strategy. Number three, coordinate your timeline. There's a lot of moving parts. You need to make sure that they're all in sync. Number four, determine the appropriate title that you're going to hold this property and make sure it's coordinated with your estate plan. Number five, if you are going to rent, examine all the moving parts, really crunch the numbers. Number six, calculate the tax impact for the different states that might be options for you, and then choose accordingly. And seven, make a plan to establish domicile or maintain domicile in that preferred state. So that wraps it up. We're going to move on to questions. We have quite a few already stacked up. But before I hand it off to Jeff, I know this is a lot to think about. We've distilled this down as much as possible, covered a lot of ground in under 30 minutes, but there are a lot of complicated moving parts. So if you are working through this process, we'd welcome you to reach out to a Savant advisor to help you sort through all these complex decisions. So Jeff, I've seen a couple questions in the chat. I'm not sure if you have a couple favorites you want to address right away. So I'll let you get started.
Yeah, I think, one of the first questions that we have in here is, related to timeshares, Justin, and I'm not sure how much familiar you have with those, but the question just being, can you speak about just buying additional timeshare points and the potential implications, and maybe thinking about, in addition to that, what does a timeshare look like from an investment standpoint? Do you have any thoughts on that?
Yeah, and timeshares can get really tricky. Each one has its own kind of unique considerations, so we don't really have broad blanket advice there, unfortunately. But again, that I see is sometimes a nice stepping stone to fully committing to a property and potentially another mortgage. That's kind of a mid-ground in between the short-term rental to try it and buying long-term. So timeshares do get a bad rap, but I think in some circumstances that could be an interesting option. I know that wasn't directly to the question there, specifically regarding timeshare points, but we'll see if we can follow up with that. Someone asked about online resources for comparing and evaluating the different states and locales. Those maps that we showed you, I believe those are from taxfoundation.org. So they have a really good summary of all the different tax things that we looked at, different quality of life metrics, statistics, things like that. It's a nonprofit entity, so you can feel pretty good that you're getting reasonable data from them. Okay, we continue to get some really interesting questions. Puerto Rico, Jeff. I know there's some unique tax considerations for Puerto Rico. You can essentially opt out of U.S. federal income taxation, but there's obviously quite a few other externalities with that. Have you encountered planning around Puerto Rico?
So I have not encountered this specifically with a client, but it's funny that this question gets asked. This was actually brought up in conversation the other day in a meeting that I had, because basically to the points that you had described. And the way that I always tell people and to think about this, and I think I even mentioned it as we were going through the presentation, is taxes are obviously an important consideration that you want to take into account once you're retired. It's certainly not something that you want to ignore. But first and foremost, I always tell my clients who are kind of going through this process, go somewhere where you enjoy being, where you can see you and your significant other or your family regularly getting together and visiting. That should be the primary importance as it relates to some of these decisions. The taxes obviously is an important piece. But I would never tell somebody to just, if you're a warm weather snowbird type of person, I would never tell you to just move to Alaska because they've got a really good tax code in Alaska. It just doesn't align well with your goals or your values or what's really most important to you and what you're trying to accomplish. So I always just remind people to take that into account. But as it relates to the Puerto Rico situation specifically, I wouldn't know enough, about that to give any really formal or good advice to that particular situation, but it's certainly something that probably warrants a little bit more research as you kind of go through that process.
Yeah, and for certain circumstances, the tax implications can be quite substantial because Puerto Rico has a bit of a loophole where you can effectively opt out of the federal income tax system and pay a very small amount of income tax in Puerto Rico. But that also involves, just like we talked state by state, there's a certain element of severing ties. And to make the Puerto Rico thing work, there's a certain extent that you have to sever ties with the mainland United States. So that can be a very substantial hurdle. And as we're kind of on that domicile topic, there's a couple other questions as well. So what if you'd like to maintain your current residence, but change your domicile to another state? So basically turn your primary into your secondary. Definitely it's doable, but you, again, need to go through all the steps. The first thing is the amount of time, but again, it's not the only thing. The 6 month plus a day rule is not gospel. It is one of the factors that different states consider. Again, it's about where is the rest of your life tied to. So Jeff's in Chicago and I'm in Arizona. If this person was asking the question was in Chicago and they wanted to move and become an Arizona resident, I would say, first of all, you need to plan to spend more time in Arizona than you do in Illinois. You also need to do all the things that Jeff said. Change your driver's license, change your mailing address, change your voting registration. Your life needs to be tied to that new place. So your doctors, where your pets live can actually, there are court cases where people have been sued by their former state saying that they're a resident because their pets spent most of the time in that other state. So the states have broad authority to review the entirety of your life and make a determination if you are or are not a resident. Illinois has a couple famous court cases on this. New York has a number of high-profile court cases that are actually kind of interesting, specifically with celebrities and athletes and things like that. And it goes well beyond just how many days are you physically in person. So again, look at all the different ties between the two states and move them deliberately into that preferred state you want to be in. Let me see here. Jeff, I know there's a couple questions on mortgages, and something that I've been coming up across a lot is this is an incredibly hot housing market across the country. If you're looking to buy a second property, potentially out of state, it's really, really difficult as a remote home buyer to be competitive. So it can often be helpful for people to come in with a cash offer. Do you want to talk about some of the strategies we can use that even if a mortgage is the right fit, how you can still structure things to come to the table with a cash offer?
Yeah, and I'll even build on that a little bit, since I kind of brought up the idea of potentially a margin loan where you're able to lend money to yourself, via your investment portfolio. So as it relates to the question of, it's a hot housing market, sometimes if you go in and you're not willing to offer full cash or whatever it may be, sometimes you lose out on the property because somebody else is willing to go all cash or maybe put in a higher dollar amount in terms of what they're asking for. And I think this is what's really unique about a potential margin loan, where you're basically borrowing money from yourself in your investment portfolio. Taking money out at that time, you get basically what is a cash distribution. Well, it's not cash distribution, but you get a cash outlay to you that you can then use to purchase a second home. And then you are basically paying back a loan to yourself within your investment portfolio. The reason that you do a margin loan is you then don't have to sell any of the actual underlying investments and have to pay capital gains tax at that point in time. Also, the interest on your margin loan is considered an investment related expense, and therefore can be used to offset any income that you have from your portfolio as well. So you get a nice little tax benefit there as well. Now, a margin loan isn't always the right thing to do for everybody, and not everybody always qualifies based on how their accounts are titled in the various and different investment vehicles that they have. But it's certainly something that if you're looking to come up with maybe a larger dollar amount initially, you could potentially take that margin loan from one of your investment accounts. And then once you have that account, or once you have the house kind of set up and you're okay with at that time, potentially maybe doing like a cash out refi to pay off your mortgage loan and then amortize, a mortgage over 30 years, that can be an attractive option for a lot of retirees, especially those who are looking to close quickly. So that's always one thing I tell people to keep in mind. There's always various different ways to get money. You don't always have to sell investments within your investment portfolio to come up with cash and end up paying a bunch of taxes in order to do so. So I would just challenge you to be a little bit more strategic and thoughtful as you kind of go through some of those processes. And if you have questions, don't be afraid to ask for a second opinion as you go through that.
Yeah, absolutely. You just got to be a little creative, and even a cash offer doesn't necessarily, again, you don't necessarily need to have that cash in the bank to make a cash offer. You can use a margin loan. You could then do a refinance shortly after the purchase closes, and you basically pay off the margin loan with a traditional mortgage. So even if you want to be in a mortgage, you can still come up with a strategy where you come to the marketplace with a competitive cash offer, and you can waive loan contingencies and things like that. While we're still talking about the domicile thing, another interesting note came up about selling a home in Illinois, moving into an RV full time. The number of folks going into an RV type of lifestyle has skyrocketed over the last couple of years, specifically since 2020. So can you maintain Illinois as your domicile without owning any real property in Illinois? Yes, you can. There's actually case law that's part of severing your domicile. You could move to the moon or live on a boat in the ocean, but until you sever your domicile, that state still has a claim to you as a resident. So there might not even need to be any specifics there. You'd obviously want to maintain a PO box or something that keeps you tied to the state, but not actively having a residence does not sever your domicile. Back to the mortgage conversation, Jeff, we've got a number of different mortgage questions. Is it better to go with a 30-year, a 15-year? This is a really common question we get in retirement. People don't necessarily want to take on a 30-year mortgage if they're in their 50s and 60s. What are the considerations in planning things you go through when you're considering 30 versus 15?
Yeah, one of the first things I always ask clients is, what are your overall feelings on debt? And is it, when you think of debt, does it feel like a burden? Is it something that drains on you emotionally? Do you think about it a lot? But then I kind of pose them the question of, well, it's not really debt in the sense that if you know you could pay it off tomorrow, it's not really debt, it's more leverage at that standpoint. Whereas you're leveraging kind of the portfolio that you have to produce cash flow for you to cover that monthly payment. And if you're able to borrow at, let's just say 3% for a round number, and your investment portfolio earns, let's just say 6 to make the math easy, that excess 3% is just money in your pocket. And that's kind of what gets back to the conversation around leveraging versus debt. Debt is more of a high fixed payment that you can't really get around. It eats into your monthly cash flow. You don't have a lot of flexibility. Whereas leverage, in the sense of a 15 or a 30-year mortgage, you're basically just leveraging the portfolio to generate that income for you and meet that monthly payment. So I tend to like the 30-year mortgage better for retirees because it provides more flexibility in terms of keeping their payment low throughout their life. And when you're on a fixed income, once you're retired, you want as low payments as possible, just in case you go through a time period where the portfolio doesn't perform as strongly. It provides you a little bit more flexibility.
Yeah, and those are great points. And there's a tax component to it as well that tilts in the favor of leverage, because many retirees probably have an IRA balance that is substantially larger than the home they want to purchase. So technically they could go pay cash tomorrow for that house, but it necessarily wouldn't be smart because you'd have to pay ordinary income taxes, probably at a high marginal rate, if you distributed all that money out of the IRA. The mortgage lets you stretch payments over time, which means you get to stretch the tax impact over time for generating that cash flow. So when we compare those side to side, Jeff, I know you do this analysis as well, between that return differential and between the spreading the tax impact, it's usually, even though it can feel a little counterintuitive, a longer 30-year mortgage oftentimes wins out. Let's go to some additional questions. We had a question about passing a property down to the next generation, and a property specifically that had a mortgage. What are some of the options there? Obviously, you could pay off the mortgage. You could make the mortgage transferable potentially. That comes with its own host of complications, and your lender has to be okay with that as well. That could be an instance where life insurance makes sense, where you have a dedicated life insurance policy that is designed to pay off that mortgage so that you can more easily pass down the property. And then again, depending on where you're at with gift and estate tax considerations, you might need to think about a more advanced strategy and toolkit around this to be advantageous there. So great question. A lot of complex issues depending on how that plays out. Jeff, we had a question. If we're relocating to Europe or somewhere else, can you continue to draw Social Security?
Yeah, so I'm not familiar with this particular situation, Justin. So you might have to, bring in some of the details as well. But I don't believe that would be an issue in terms of being able to collect Social Security.
Yep. Yeah. If you were entitled to it, again, it doesn't matter if you're living in the States, in Europe, on the moon, in a sailboat in the Pacific Ocean, you're still entitled to those dollars.
Yep.
I saw a question come in about specifically about Arizona income taxes. So I'll go ahead and field that one. On the map, you actually saw that the Arizona income tax rate was listed at 8%. I think that caught a couple of people by surprise because Arizona's never been a zero tax state, but it's often been thought of as a tax-friendly state. There was actually a voter proposition in the 2020 election that imposed a 3.5% high income surtax. So the ordinary income tax brackets in Arizona cap out at 4.5%, but this surtax came in and added a 3.5% surtax on very high incomes. Now, what's interesting is that surtax is actually being kicked around in the Supreme Court and may not actually come to fruition. And that actually ties into another question we had about political considerations. A lot of states are moving, over time. Just in the last 5 years, I can think of 3 or 4 states that have materially changed their income tax structure or removed the estate tax. And a lot of times they're trying to attract new people. Tennessee was a great example. Tennessee did not have an income tax on ordinary income, but they did tax interest and dividends for a number of years. They ended up getting rid of that to make it a true zero tax state. So the question was ultimately, should we be watching the political situations in different states and factoring that into the relocation discussion? I would say, yeah, it's worth keeping an eye on. Again, this is such a complex decision with so many different moving parts. Taxes are rarely the deciding factor, but it doesn't hurt to be watching that. And let's say you have 1 foot in state A and 1 foot in state B, and state B is making moves to reduce or eliminate their income taxes. You might want to start thinking about a plan to shift your domicile to state B.
And Justin, there's one question that came through, and I think it's a really good question. It doesn't get asked enough, so I just want to make sure that we walk through this for everyone who's on the call. The question is, I'm thinking about potentially buying a second home, for my use, me and my wife's use, but also as kind of a family legacy gift for my kids and grandkids for us to spend time together. Should I be, having a conversation with my kids about whether they would want to maintain this property after me and my wife are gone? Is that something important to them, or is this something that should be a decision just strictly between me and my wife? Do you have any thoughts on that? I know I have a couple, but I wanted to see if you had any initial thoughts on that.
Yeah, I think it's always great to start that conversation when you still can, instead of trying to guess at or dictate what people should do or what you want them to do with a property after the fact. So again, it's a tricky, complex, deeply personal conversation, but having that conversation is almost always very helpful to have upfront. The earlier, the better. Really get clear on what people want, what people don't want, and then you can plan accordingly. The worst thing that can happen is that you find that child 1 and child 2 and child 3 all have different viewpoints on the lake house or whatever it might be, and you can start proactively planning ahead of that. So Jeff, I'd love to hear your thoughts as well.
Yeah, I know. I think you kind of hit the nail on the head. I do tend to agree that it's best to have those conversations with your kids ahead of time, especially if this is really more of a family legacy piece for you and your family. Just setting expectations of what this property means to you and your spouse and what it's meant to be for you and your family. I think that helps provide a lot of background that sometimes goes missing when you don't have those conversations. And then when the time comes when we're no longer around and now the kids are faced with either managing the property themselves or selling it, they're so more so just, well, was mom and dad's, they bought it for themselves and, we'll just do whatever we want with it. But if that doesn't align with your intentions of why you initially purchased the home, I think that's really kind of an opportunity that you may be missing out within your family to have that, really important conversation. Certainly not something that you have to do, but since the question came through, and I think it's a really good question that doesn't get asked enough related to second homes, I wanted to make sure that we addressed it.
Yeah, and we had another question here asked, do people typically change advisors when they move? And if so, does Savant have other advisors in other places? Yes, Savant has advisors in other places. We've also found in the last 2 years, the way that we interact with clients has gotten a lot more flexible and virtual as well. So I know, Jeff, I'm sure the number's quite high for you. I have a large number of people every single year that are moving. 2021 might be setting the record in terms of clients who are retired, who are moving or buying that second home. And here at Savant, we're very well equipped to deal with people wherever they are. We have a large and expanding national footprint as well, which is great because if you are somebody who really prefers to meet in person, we can meet those needs. And if you're okay virtual, we've proven that we can do that as well, working with people across all 50 states and abroad. Okay. Jeff, did you see any other ones? I don't see anything else in the queue.
No, I think that actually we're tackled most of them. If we didn't get to your questions, we apologize. Obviously, there's hundreds of questions that get filtered through here, and we try to catch them as much as we can. But if there's any, if you have any follow-up questions where maybe we weren't able to get to a specific question of yours, as Justin said earlier, don't be afraid to reach out. We're more than happy to help you through the process or answer any questions that you may have.
Yep. And then just as a closing remark here, there will be a survey that's going to pop up after this webinar ends. So that's a great place. If you have a specific question, you can enter it there. You can, put any requests for follow-up as well in there. And then if at any time you're looking for additional information about Savant, what we do, how we can help, please just go to savantwealth.com and learn more. So with that, we're going to wrap it up. Thank you again so much for your attendance today and have a great one. Thanks.